Hello everyone, this is Osama from Primary Vision Network and welcome once again to Monday Macro View. New improved look with a haircut. Unfortunately, things with the global economy aren't new and improved. Today, I would really want to just talk about how there has been a proper shift in the collective global sentiment when it comes to global economic recovery. A little story. So when COVID-19 ended, or it peaked, people started to talk about how demand will return, and it did. But what happened during COVID-19 was there was an unprecedented increase in money supply. That increase in money supply was most of it was made when interest rates were either very low or, in fact, in some cases, zero or negative. So there were trillions of dollars of pandemic purchase programs, uh, benefits for the poor, and other safety nets. But all of it did one thing, that it increased the money supply at a very low interest rate. But after that, the interest rates started to hike, and here we are right now. It was actually a very natural outcome of events if you look in retrospect. And today I would just like to talk about a little bit of indicators that are actually showing that a recession is due. And now the debate is not if, it's only about when. Nobody knows. I don't know. Maybe it'll be next year by the year end or something. Maybe it will get triggered in the South Asia or other emerging markets, or maybe it will get triggered in the UK, which is doing pretty bad recently actually. So yeah, let's jump in. First, this was a very interesting chart. Interesting in the way that it shows how much sentiment or how much the recessionary fears are weighing down on markets. You look at this downward line here. It's a steep line, it's a plunge, it's a dive, and this shows the losses in global bonds and stock markets. We'll see in the coming slides that what is the exact amount of it, but just on the outlook of it, it looks pretty bad. If we turn towards volatility, so at Primary Vision Network, we always sort of try to come up with the word of the year. During 2021, the word of the year for us was cautious optimism. I really like the word because I used to use it in the research articles that you can read on our website. I write them every week. So from cautious optimism, things just went really optimistic. People started to have a very, very rosy outlook of markets, and unfortunately, it had not hold true. Right now, volatility or uncertainty, I believe, is the word of the year. It's perfect because volatility remains high. You can see it. It's not only the VIX index, which is called the Wall Street Fear Gauge as well, but it's the other indexes as well. You can see all of them are moving in one direction, steeply rising. And I've written about it as well, and I was joking this with a friend the other day, that it is one of the most toughest periods to be a trader actually, because literally no one knows what is happening. One day oil prices rise, next day oil prices fall. One day there is a supply concern. If we talk about oil markets, next day there is demand destruction coming up. So we don't know what's going to happen. And this has been the first time in decades, this recent time, that S&P 500 has closed negative after gaining, and I'm talking about since 1938. So that's a very unique phenomenon. Once again, my fundamentals are there. You can check it out on the internet. But this really speaks about the sentiment, which I believe personally, and maybe you agree or disagree, that they accentuate, aggravates, increases the already fundamentals there. So if there is a supply shock coming up, the sentiments will really drive the markets crazy. This is what is happening in the opposite direction right now. So this is the amount, $32 trillion, that was wiped off of global markets in 9 months. To put it into context, this was the same amount of gain that was amassed in the global economy over twice the period, almost 2 years. After the pandemic and during 2021, this was what the markets gained because of ports opening up, economies opening up, supply chains getting easy in one way, and demand rising, factories restarting. But in 9 months only, all of it has been lost. And this is where I mean, this was really interesting. Germany has been really unfortunate, as in it faces a flurry of problems right now. Climate, droughts, we all know, then geopolitical issues, of course, and economic and energy issues. So inflation has hit a 70-year high in Germany. Actually, it's not funny, but it's really strange and interesting that in almost all of the countries around the world, inflation has decided just to hit around decades high. And the record is either 30 years, 40 years, 50 years, and 70 years. So inflation in Germany is at 70 years high, and economists have warned of a recession. The GDP is expected to fall down almost 7.9% in the worst case scenario. And let's be very honest, things have been getting worse. Despite, and this is actually what the next slide says, despite the European economies getting for being successful in filling their gas inventories more than 90%, it is not certain that they would go through the winter smoothly. Why? Two things, and I've explained this before as well. Gas inventories only work when there is a continued supply of gas from the Nord Stream pipeline as well. That part has halted. Secondly, according to recent figures from the European research centers, the winter is going to be quite harsh, dry, and cold. What does that mean? That people are going to need more gas to heat their homes, and industries and businesses are going to need more gas as well. However, according to different plans, in order to survive through the winter, this winter, Germany and other countries would need to save their gas by 15%, 15 to 20%. Given the harsh expected harsh weather, I don't think that is possible. And this isn't only about this winter. It'll go beyond that. We can see a redux of this next year because, frankly, unless things between Russia and Ukraine settle down one way or the other, I don't think we should expect any stability in the markets. If anything, things have been moving in quite the opposite direction. There has been an escalation, referendum, and whatnot, and this is where we stand right now. Finally, to leave you with the market sentiment tracker, I think there has been a somewhat balancing because the main concerns of China's oil demand, they were relaxed a little bit. Traders were appeased because China's COVID lockdowns, the curbs have reduced, and people are expecting an oil demand bounce back from China. And China is one of the largest consumers of oil, so that's pretty natural. However, if you look at this side, once again, the recessionary side, volatility is high. I've told you high since June. Steep fall in global bonds and stock markets. Germany's inflation we've discussed. Eurozone's inflation is still there. It's pretty high, highest actually. The grocery bills, talking about food prices, the grocery bills are still in the US. There was a 13.5% increase year on year. And this is the largest 12-month jump since 1979. What does this do? This affects the common man like you and me, and things are not looking good. Even in terms of mortgages, we spoke about the mortgage rates, but recently there has been, interestingly, it's a glitch. There has been an increase in selling sales of house, but that is mostly because constructors, builders, home builders are trying to reduce their inventory by reducing the price. So that's also not a good sign. On this side, things pretty much remain the same. I don't see any new geopolitical risks. It's an extension of the old ones from the past 2 weeks. However, I believe the market outlook is something that the recessionary fears are now piling up. And I think this will continue to weigh down on the global market sentiment. So that's all from today. The main message was that the recession is getting very real. Many mainstream media names, economists are joining the chorus of it. And we will see what will happen. But things are looking pretty tough in the future. Thanks for listening and let us know in the comments